Hi, everyone. Welcome to another episode of this Learn on the Go series. And if you've been following this series or any of the previous videos on my channel, then you already know how much I lean on data. But more than data, I think it's the analysis, the interpretation of it that's all the more important. And it's also an area where I've seen a lot of people make mistakes and they tend to falter quite a bit. Therefore, in this video, I'll take you through certain scenarios, some situations where there is that imbalance between data and its interpretation. And obviously, a better understanding of it will make us better investors. That said, it's definitely possible. Some of this might be a little basic, but if you know anyone who might find it useful, then I'll request you to kindly share this video with them as well. All right, so as a SEBI registered research analyst, I do have some responsibilities and some rules that I need to follow, which I'm definitely complying with. Please do read this disclaimer, and to put it in a sentence, everything discussed on my channel, that is the video, the comments, the description, etc., all of it is educational in nature and none of it should be construed as recommendation of any sorts. Okay, let's start with situation number one. And you are likely to find a lot of this on Twitter, where there are thousands of people doing chest thumping announcements that they have made 40, 50, even 100% returns in a short span of time of, let's say, a month from now. Some of it might be true, most of it is not. But from a data analysis perspective and as a consumer of this content, there are a couple of questions one should ask oneself. Firstly, is this absolute returns or is it annualized returns? And secondly, what's the period of investments? In other words, was this 50% achieved in a single month or was it done over a 1 year period? Now, some of you might say, Arey, likha hua hai na 1 month. But believe me, on social media, things aren't so simple. Okay, quick example. And let's say this person makes a return of just 4% on a stock in a single month. This is quite common when dealing in stocks. But then when one analyzes this number, that is 4% multiplied by 12, this comes to 48%. और अब ऐसा लगता है कि इस बंदे ने फोड़ दिया, and of course he or she is going to use social media to amplify this message. But remember, this data is absolutely correct. There's nothing wrong in it. But the way we interpret this information makes a massive difference in terms of what's good, bad, and ugly. The same thing can be seen with benchmarks as well. And if one isn't careful, this can lead to a wrongful representation of the facts. For example, let's say this is my portfolio, so 5 funds, and let's ignore returns for the moment. Now, if you haven't thought of it enough, there is no saying what you might use as the benchmark. Some might use the Nifty 50, someone would settle for the Nifty 500, the Nifty 200, etc. And the point is that the lack of a benchmark that kind of mirrors your portfolio is only going to lead to wrongful conclusions and is very likely to disturb your analysis. For instance, in this case, here's the split between large, mid, and small caps. So large caps are anywhere from 97% to 59%. But when we see it as a portfolio, in our case, about 78% of the assets are into large caps, with 17% in mid caps and the balance 5% in small caps. Now, in terms of benchmark, one could have chosen any of these three, the Nifty 50, the Nifty 500, or the Nifty Large Mid 250 Index. And as we can see here, the Nifty 500 comes closest to our portfolio. I took this a step further, and on a 1 year basis, our portfolio of 5 schemes would have done a good 5 percentage points better than the benchmark, that is the Nifty 500 TRI, giving us a more precise understanding of where our portfolio stands against its benchmark. The same benchmarking exercise is important with individual schemes as well. And just because many of these small cap schemes have delivered over 20% returns in the past 3 years doesn't make them the best of picks. Why? Because in the same 3-year period, their benchmark, which is the Nifty Small Cap 250 TRI, it did a lot better at 24.6%. Of course, this might open another debate of active versus passive. I don't want to be a party to this. But one thing I'm sure you've noticed is the performance difference between the benchmark index and the corresponding index funds. Now, this is generally the case with small caps, momentums, and theme-based indices. That is, if the benchmark does X% returns, then the index fund performance is lower by 1 to 2%. This is generally an observation, but all the same, it's always good to keep this reality into account whenever we do our analysis. Okay, this third scenario is very simple and it always shows up whenever I do a reveal my portfolio exercise. Let me explain this with the screen grab. So it says here I have invested 4.2 crores over the last 10 years, which is true. And it also says that I have a total corpus value of 6.05 crores, which is also true. Now, someone who is not analyzing this information properly might come to the conclusion that I have invested 4.2 crores and I now have some 6 crores. So essentially, over a 10-year period, my 4.2 has gone up to 6 crores, which probably is a CAGR of 4 or 5%, which is not the right way of looking at this. I know this might sound comical to some of you, but believe me, there are enough comments to this effect. And what these people have generally done is that they have simplified their understanding of what was invested and what the corpus is at this particular moment. However, in the real world, do remember investments are never lump sum. They are staggered over a period of time, and 10 years is a lot of time. Secondly, the amount invested is not the same, as in it's not like an SIP wherein I put in 10,000 rupees and it's continued for the next 10 years. We normally tend to increase the amount of money invested over time. And thirdly, there are also withdrawals and redemptions that can happen for a number of reasons. Basically, the cash flows are erratic, which means the standard CAGR formula won't apply here, and we'll need something else to get a more accurate understanding of our investments. Actually, let's understand this with an example. Let me open an Excel sheet and say on the 1st of January 2020, I invested 50 rupees. Now, because the markets have done very well, today is the 15th of October 2025. Let's say this 50 has now become 200 rupees. But this is not the only transaction that I've done. Let's say on the 1st of January this year, so 2025, I received from some source, let's say I received 370 rupees. So मेरा provident fund का पैसा आ गया था. And again, that 370 in 10 odd months is, let's say, about 400 rupees. So essentially, my corpus is 200 rupees plus 400. So let's put this here. And this comes to 600 rupees. So essentially, if you're going to do this incorrectly, then what you'll do is you'll take this 600, you'll divide it by 420, that is 50 plus 370. You would do raised to the power 1 divided by 5.8. 5.8 represents the number of years. And take the entire thing, we subtract it by 1. So this comes to 6.34%, which is absolutely wrong. Instead, what we need to use is a different formula, XIRR, the extended internal rate of return, which simply calculates the annualized return on investment on cash flows which are occurring at irregular intervals. Let me show this here. And so before you do the XIRR formula, we have to make a differentiation between which entries are cash inflows and which ones are the outflows. So with 600, what we'll do is let's make it minus 600 to express the outflow, while the invested amounts are 50 and 370. Now we'll use the XIRR formula. So XIRR brackets open, we add the values. There are just 3 values, the dates now, and for guess, I'm just going to put in 0.1. And there we go. So we have a XIRR value of 22.9% to be precise, which is the correct reflection of how my investments have performed and is obviously a lot more accurate than the 6.34% that we received. My point is always use XIRR for a better understanding of your portfolio returns. And if one just goes back to that screenshot, notice here my XIRR on the day of recording that video was 12.8% and not the 4.2% that someone had said in the comments. A fourth scenario and a comment that almost always pops up whenever I'm talking about my 3x3 grid is that ये सब करने की क्या जरूरत है यार? Just put all your money in a small cap index and you can easily make 30% per year. Now I know where all this confidence comes from. Let me just show it to you. So I'm right now at Value Research Online, and let me take the 5-year returns of different funds. And yeah, so see here. So there are lots of funds which have done more than 30%. 1, 2, 3, 4, 5, 6, 7, 8. So 8 funds have done more than 30% in terms of returns. And as we go down, I can see, oh, this is interesting. So this one, the Motilal Oswal Nifty Small Cap 250 Index Fund, even that has completed 5 years. And over a 5-year period, it has done 27.6%. All this is fine, but the problem really starts when one starts extrapolating this information and assuming that the next 5 years will be as good as the previous 5, and that small caps will have another 30% return over the next 5 years. This is definitely not how things work. And just to explain this in numbers, what I've done here is I've taken the 5-year CAGR across different years, not just for the small cap index, but I've extended that to mid caps and large caps as well. So you can see here the 2020 to 25, the performance is right there at the bottom. The small caps have definitely done extremely well. But when we extrapolate, or rather, we populate this information over different periods of time, we can see that it's only in one 5-year period the Nifty Small Cap 250 Index outperformed the Nifty 100 and the Nifty Mid Cap 150 Index, while the Mid Cap Index came on top 8 times, and even the Large Cap Index did well twice in a 5-year block of time. So essentially, this affinity towards small caps is nothing but recency bias. And one acceptable way of solving for this is using rolling returns. And what is rolling returns? Well, very simply, rolling return measures how an investment has performed over multiple overlapping time periods. A practical way of understanding this is to use advisorcoach.com. I use it all the time. And within MS Research, just go to benchmark return. In here, you'll see benchmark rolling return. Just tap on this. And now you can see a series of benchmarks. You have start dates. You also have rolling return periods. Let's stick with the Nifty Small Cap 250 TRI. Let me change the start date to, we used January 1st, 2010, if I'm not wrong. So let's do this. And in terms of the rolling return period, you have a bunch of options. You can choose anywhere from 1 year to 15 years. We're going to do 5 years. All right, so this gives us this graph here where what has actually happened, practically has happened is the website has mapped out a continuous time series starting all the way back from January 4th, 2010 until January 4th, 2015. So it's given what was the CAGR during this period, which was 11.47%. And this has been done for different dates starting all the way from 2010 until the year 2020. So the last date on record is October 30th, 2020. And again, the performance has been mapped as a time series. So these are a number of observations, must be like, maybe, I don't know, 3,000, 4,000 different observations which are there. But what you really need to focus on is this table here now. So see this, there have been certain periods where performance has been really good. So there's been even a 40% CAGR over a 5-year period. And there's also a period where things were actually negative for a very temporary period of time, again, because of COVID. But let's ignore both of them, maximum and minimum. I think this is more important. So the average and the median. So 14 to 15%, I think that's what your expectation should be from the Nifty Small Cap 250 Index over the long term based on historical data. And yeah, I'll definitely suggest you go through this particular tool, advisorcoach.com. There's a lot of stuff inside it. And more than the data that you can extract from here, I think one big advantage of this is that it will help you frame your expectations better, and it will be a lot more realistic rather than you kind of getting absorbed with recency biases and all kinds of prejudices when it comes to your forecasting. Okay, so we have done a lot of mutual funds and index funds. Let's move on to stocks. And one of the things I've observed is that many people, and by many, I mean, like 90% of the people, they tend to focus on either the sales growth or on the profit growth. What I mean is that between sales and profits, there's a lot more stuff right in the middle. And by ignoring these other elements of the P&L, they are only uh, attracting catastrophe and mistakes in the analysis. Let me explain this with a few examples. The first one I have is from the paper industry, JK Paper. Let's go to the profit and loss statement. And just below the sales numbers, which is what a lot of people see, is this thing called expenses, which includes things like the raw material cost, the employee cost, marketing expenses, operational expenses, etc. Now, what has happened is that while the sales growth have been very static over these last 3 years, so 6,400, 6,600, 6,700, you notice that the expenses have increased dramatically during that period. So from 4,400 to 5,000 crores to 5,800 crores. Now, if you're someone who would only look at sales growth, you would have probably said, अरे इसका sales नहीं बढ़ रहा है. But the bigger problem is that the expenses is increasing at an even accelerated pace. And obviously, a lot of it is due to an increase in the raw material cost, which has gone up from 44% in the year FY23 to now 61%. And because of which the operating margins have come down from what was 31% in FY23 to just 14% now. This is definitely an area of concern for JK Paper. And by the way, I'll be doing a video on the paper industry. Just give me a couple more weeks to put something good together. And I'm sure the focus will be on why have the margins gone down so dramatically over the last couple of years, and what are the triggers through which it can come up again. So just give me a couple of weeks for that. But let's go further. And now I want to focus on three more areas. This part on other income, interest, and depreciation. So this is the mid part of the P&L statement, if I can say that. And with regards to other income, there is this company on which I had done a video as well, Deep Industries, which kind of explains this very nicely. So the crux of the matter and what I had highlighted in my video is that for the year 2025, FY25, while the sales have been good, even the profit margin has been excellent at over 40%. However, the company finally finished at a loss of 79 crores as compared to a profit of 125 crores a year back. And this was largely due to this particular P&L item. And under exceptional items, you can see a loss of 258 crores. So actually what had happened there is that this company, Deep Industries, had acquired a couple of companies as subsidiaries. And as a cleanup part of those companies' balance sheet, it had to kind of write off a lot of inventory and debts, which are probably bad debts. And in the process, they had to book this loss of 258 crores. My point is, if you're someone who only looks at the bottom line, that is the net profit number, so you might get a little scared looking at minus 79 crores. But if you had actually gone through the exceptional items part as a part of the balance sheet, you would have noticed that this is just a one-time loss, which the company has decided to book. In the same way, line items like depreciation and interest can have a big impact. I'd explained that in a video on Craftsman automation. And even taxes are something that cannot be ignored. For this, you can look at Paramount Communications and look here. The company had accumulated a lot of losses during this period, FY 14, 15, and 16. And from FY 17, when it started to make profits, it was able to use much of these accumulated losses to get certain tax advantages. So that extended all the way from FY17 until FY24. Starting FY25, those tax advantages are over, and you can see the impact here. So with tax advantages, so it was around 0% taxes, the company made a profit before tax of 82 crores and was able to show somewhere on that number as PAT. But in FY25, it made 111 crores as profit before tax. But because there's a 22% tax involved, the net profits are pretty much where it was in the previous year. So the point I want to make here is that it is very important to look under the skin at all these line items within the P&L, which is also why I feel that Screener is a very inadequate tool when it comes to picking stocks. I'll take one more example to explain this. So this is NITCO Limited, and it's an extremely unprofitable company which has done years and years of losses, except for this 1 year, but that's because of some other income coming in. But let's look at the quarterly results, and you might notice something very strange and pleasing that in the last quarter, which is Q1 of FY26, the company has actually posted a profit of 47 crores. But when we again start looking at the data more intently, what might come as a surprise is how the sales have grown. At least if you take the last 2 quarters, they've grown from 85 crores, 94 crores, and then has jumped up to 150 crores. It's possible. I mean, I'm not denying that a company can't jump its sales, but what's remarkable is that this jump in sales has happened without any incremental expenses. So when they did 85 crores of sales, they had expenses of 90 crores. The company did 94 in Q4 of FY25 at an operating expense of 100 crores. But when it did 150, how is it able to do it at just 101 crores? So that's a question that should raise a few eyebrows. And when I investigated further, what I saw, you open that. Yeah, so you see this press release that came in on 14th of August. Okay, let me show you this. Yeah, see what it says. The revenue boost came largely from the Alibag land development deal, which contributed 58 crores during the quarter as an interest-free adjustable advance. So essentially 58 out of the 150 crores has actually come from this land monetization deal that this company has done, which means on a standalone basis, if you purely look at the operating income, it was still only 92 crores. And against the 92 crores of sales, going by the normal trend, the company had an operating expense of 101 crores. So it's still unprofitable. The operating margins are still negative, even though Screener is showing us a much healthier picture, an operating profit margin of 33%. But the fact is that it is still negative, and it's, I think, again, minus 7% is the actual OPM for NITCO for quarter one of FY26. So this is another example of how looking at things on a more deeper level really helps, and you get a real understanding of how the company and how the stock is moving. Okay, let's continue. And another source of this imbalance between data and analysis is the screening software that you use. Let's stick to Deep Industries, those 258 crores of exceptional loss that I talked about. And what we want to see is that how different screening platforms are handling it. Let's start with Screener, and yeah, this seems fine. There is a separate entry for exceptional items, and it captures the 258 crores. This is Tijori Finance, and within Deep Industries, let's go to financials. Let's go to the P&L statement, and yeah, I'm not able to kind of detect where the exceptional loss is. So see, it's the operating profit is coming as 231, which is fine. Then there is some other income, depreciation, interest, and then suddenly the PBT is minus 40 crores. So there is a gap here in terms of where this extraordinary loss is being captured, and that can mess up your analysis. It's more or less the same problem with ticker tape, and observe this. So you have operating and other expenses as 525 crores, which means what these guys have done is they have combined the operating expenses and the exceptional losses which are there into a single entry, and they have kind of clubbed it to make it 525 crores, and therefore your EBITDA, which in all the cases was some 230 crores or something, in this case the EBITDA is coming as only 12 crores. So I'm now on scanx.trade, and let's look at the annual financial results. Right. So I think this is similar to what we saw with Tijori Finance, as in the EBITDA is coming here, but then the breakdown is not available of how does this 264 becomes minus 40. So I can understand. Let's knock off depreciation. Let's knock off interest. So this is 53 crores. So 264 minus 53. Okay, you're down to about 210 crores. But then how does it become minus 40 of PBT? So that's again something that this platform has not answered. Of course, that doesn't mean that Screener is always right. Let me give you a few examples where Screener also can confuse people. The first anomaly is the PEG ratio, the price earning multiple to growth ratio. It's a metric that was popularized by Peter Lynch. And from all I've heard, the formula should be the current P ratio, that is the trailing 12-month P ratio, which is then divided by the expected EPS growth rate. But when one examines this on Screener, the formula seems to be a bit different, as in while the numerator is the same, that is the 12-month trailing P ratio, for the denominator, the platform seems to be using the historical 3-year growth in profits. You can check this out by yourself. Let's look at Azad Engineering, and let's go to the P&L. Right, so I said probably what this is doing is using the 3-year growth in profits. So let's examine that part. So net profits is, it was 28 3 years back in FY22, and it's now 89. So let me just pull up the calculator. Okay, so 89 divided by 28, this comes to 3.18. Let's just do it raised to the power 1 by 3. This gives us 1.47, so minus 1, and we have 47%. So the profits for this company, Azad Engineering, that has been growing by 47% over the last 3 years. So this is our denominator. For the numerator, let's look at the PE ratio, which is 107. So let's do this. 107 divided by 47. So numerator is the trailing 12-month P ratio, which is 107. The denominator is the historical 3-year profit CAGR, which we calculated it as 47%. So 47 here. This comes to 2.27, 2.28. And, on Screener, I think they give us the PEG ratio somewhere. Yeah, look at this, 2.28. Right. So that's what I had on the calculator also. So 2.28, it's exactly the same number. You can try it for different companies and you'll probably get the same number. So this is my understanding that what Screener does is it takes the historical numbers and it doesn't take EPS numbers. It takes the profit numbers, which is not exactly my understanding of how the PEG ratio works. But I don't kind of blame Screener for this. It's very difficult to project future numbers. I mean, that's what investing is all about. Investing is nothing to do with what the company had done in the previous 3 years, 5 years, etc. It's about what it's going to do in the next 1 year, 5 years, 2 years, etc. So that's anyway the mission of any investing exercise. But if I have one suggestion for the Mittal brothers who own Screener.in, it is that they should try and use use AI, and they've built in certain things inside the platform now. So use AI to at least project what the company's future EPS can be, and then you can model it to give a more accurate picture of the PEG ratio. Cool. So we've done quite a bit in this video. I think 7 scenarios. I hope some of it stuck with you. And the focus here is completely on improving one's decision making. Just because a number is there, it really doesn't mean you have to be doing anything with it. I mean, there are certain numbers which will be very useful, but they might be hidden. There'll be certain numbers which might not be practical at all. And that's why you'll have to use whatever you've learned so far in terms of probabilities, in terms of correlation, causality, all these concepts that we have learned in school, I think that is a lot applicable here also. So I just wanted to give you a glimpse of certain scenarios that I have gone through over time. And yeah, I hope this was helpful. If you have any questions for me, please do punch it in the comments box below. And if you have certain scenarios where you might have made mistakes or you've seen others making mistakes in terms of interpreting the data, then please do share it in the comments box below. Once again, thank you for your time and I wish you a very happy Diwali, and I'll see you very soon.